It should be interesting though. Tiger's down 5.5% on the market today. So one of the stocks that's taken quite a hit. That won't be too much of a surprise to Jeff Blant from Cannon Asset Management. You've just been doing a lot of analysis of the big stocks on the JSE. And Jeff, it's quite scary. We were mentioning a little while ago that your research shows if you took the big guys into a single market, we'd be the most expensive in the world.
Yeah, it's actually an interesting analysis. If you look at South Africa, our average rating in the market at the moment, we use the cyclically adjusted PE, so it's a 7-year PE rather than a 1-year PE. So you take 7 years of earnings and average it and inflation adjusted rather than
cycle to cycle.
Yeah, it's a cycle to cycle. It's the DNA earnings of a share or an economy or a market or a sector. And you put it over the current price. We think it's a better way of measuring than last year's 1-year trailing PE, because you've got the current price over last year's earnings, which could be up or down based on shorter term circumstances. So it's a nicer valuation tool. And the really interesting thing is that the South African market at the moment is on about a 16 Cape ratio, which means it's right in bang with its long-term average. So people say to us, is this market expensive or cheap? We say, well, it's actually bang on its long-term average, which then begs the next question, what's it going to do for the next few years? And we give a very infuriating answer, equity-like returns. Because the Cape ratio of 16 says you're probably going to get your equity risk premium over the next few years, about 5-6% real over the next couple of years. So the market's not cheap, it's not expensive, but the average is always made up of components, and that's where the interesting story lies. What we did is we stripped out the various sectors in the marketplace, and so we took the financial sector, the resource sector, we stripped out the large cap industrial shares, and then we did the rest of the industrial market. And we compared that around the world to see both how does South Africa's rating fit within the world, how does our 16 compare to other markets around the world, but then what about the sectors within South Africa? And there were some interesting results.
It is, the JSE is always termed as this all-share index, but in fact it's many markets within one, isn't it, as you've just explained with the way you strip them out.
Yeah, exactly. There's different drivers and different sectors. We tend to have 3 principal sectors in South Africa. In the States and in Europe and developed markets, there's typically 6 or 7 principal sectors, that will drive a market. Now, if you look at where we are at the moment, so our market as an overall market is among the most expensive quarter of markets in the world. So
that's the Alsi.
The all-share index. So the headline from that is, well, hang on, maybe you should find other markets in the world that are cheaper. Much of the world is cheaper. So that was sort of an interesting observation. The one notable exception is the US, which is on a Cape ratio of 20. So the US is apparently in a bull market at the moment. It's running nicely, but it's already expensive, at least to our counting.
But then if you take those constituent parts of the JSE,
that's now,
how do they stack up?
Now, if we go and take the parts of the JSE and said, what happens if these were markets on their own? Where do they fit? Because you're not just buying the JSE, you're buying components of the JSE. Interestingly enough, if you were to look at the resource sector of South Africa, if it were a market or an economy, it would be in the cheapest 25-30% of markets. It's attractive. Now, we know why it's attractive, because there's lots of bad news. But that doesn't mean there's not opportunities to dig and find if you're looking at that sector. Financials are midpoint in the world. So financials compared to around the world valuations are about midpoint. But the fascinating one is large cap industrials. If they were their own market, they would be the most expensive market in the world by a country mile.
Wow.
The Cape ratio on our industrial stocks, large cap by the way, not mid and small cap industrials, is 30. That is stratospheric. If long run averages are 16, 30 is huge. Our observation is if you're looking to rush overseas because of valuations, perhaps those are the shares you should look to liquidate, because the rest of the market's actually quite cheap compared to other markets.
This performance of the markets within the market, does that follow through to your index trackers?
Yeah, it will, I suppose if you look at that, so Satrix is a top 40 index tracker, so naturally it's going to have a large exposure to large cap stocks, large shares. It'll contain some of the big financials, the big resources, but a big component of that are large cap industrial stocks. In fact, they've been growing and growing. To put it in perspective, 5 years ago, resource shares made up half of the South African Stock Exchange. They now only make up less than 30% of our market. And industrial stocks, large cap industrials, used to make up 30% of our whole market, now make up more than half our market.
But isn't this a logical conclusion from quantitative easing? They're pumping money into the system and it goes into the same places and you make the same bets.
Yes, no, I suppose the observation is these are expensive. We're not saying, well, no one made a career forecasting the end of bubbles. There's a definite bubble here. Now, the bubble's funded by this liquidity supernova we've seen from the printing of money, QE1 to infinity, and this is, we know, we have a feel for what's driving this. Momentum is the winning strategy, just by what's been winning recently.
But when do you jump off the tiger? That's the thing. We don't know when QE is going to end, if it ever is going to end, some people think. So if you jump off the tiger now, you stay away from these large cap industrials, you might be looking silly for years.
You could look silly. The point is that why go and buy large cap industrial stocks in South Africa, which are, as a sector, the most expensive both relative to their history. They're the most expensive they've ever been relative to their own history, and they're the most expensive, if you want to call it, market in the world, when I can go and buy most of Europe on attractive multiples. So I suppose the argument goes, well, there's alternative investments which from a valuation perspective are very attractive, offer similar growth, by the way, in terms of prospects, but are just are in areas that are just cheaper. We often highlight the case in point. Our large cap industrial stocks, Richemont, SAB, for example, these are brilliant businesses. You want to own them. But at some stage, you've got to say these are too expensive. Richemont is luxury goods into China. I can go and buy BMW on a P of about 10. It's on a price to book of about 1.5. Now, this is about a third cheaper than Richemont, yet it's got the same growth drivers. This year, BMW must sell more vehicles in Asia, driven by Chinese demand, than they've ever, before. And so they have record sales, record margin per vehicle, record market penetration, record Rolls Royces ever sold in any 1 year. Yet our market is enamored. Now, often the comment is said to me, but hang on, these are foreigners that are buying breweries and Richemont and these companies. Actually, a lot of it is our local investors that are buying. It's not the foreigners that are driving these up. It's the market here is in a big bubble. And
exchange control isn't hurting.
Exchange control is not hurting. Let's put it this way.
Jeff, it's fascinating insights. Thank you for coming and sharing them with us. That was Jeff Blunt, who's the Chief CEO of Cannon Asset Management.